Let's start with the problem. Let's start with a problem with abnormal line of goods having different value. Here, 30 September 2024, the stock of Babu Limited was lost in the fire accident. From the following records, the following information is made available to you. Enable you to prepare statement of statement of claim. We have to prepare statement of claim. Then this is the stock on cost on 1st April 2024, stock at cost on 1st April 24. This is 2023 and this is 2024. Here, for the year 23-24, 31st March 2024, which is year 1st April 2024 is the opening balance for the next year, but for the 2023 and 24 it is the closing balance. So this is the closing balance for the financial year 2023 and 24. This is the opening balance opening balance for the financial year 2023 and 24. This is the purchase returns for the year ended 31st March 2024, and this is the sales purchase up to the date of fire. This is purchase up to the date of fire, sales up to the date of fire. Here, this is the important thing which we have to concentrate on. The value of stock on 31st March 2024 due to obsolescence, 50% of stock which originally cost 6,000 had been written off, which means in 60,000 of goods pricing, it is reduced to 50%. Other way around, 50% of goods are written off, which means it is recorded as 3,000 instead of 6,000. So we will add this on which date? 31st March 2024. While preparing trading account, we'll add 3,000 which is written off. Okay, then May 2024, which means while preparing memorandum account or current year, 3/4 of the stock had been sold at 90%, which means 60% of abnormal good. In that, 3/4 is sold at 90% and incurred 10% loss, and remaining 1/4, what they have said, it is now expected that the balance of obsolete stock would also realize on the same price, which means 90%. Then 1/4 of the stock is remaining, which is realized. Realized price is 90%. Then here also 10% is the loss, abnormal loss. Subject to the above, gross profit had remained uniform throughout. This is the salvage value. Now let's start with the problem. Opening stock is 37,500. 37,500. Purchases for the year ended 31st March 2024 is 2,53,750, and the sales are 3,15,000, and closing stock. Closing stock is, what's the closing stock? Here 52,500. 52,500 and 3,000 they were written off, so we added 3,000 back, is equals to 32,000 plus 52,000 plus 3,000, which is written off 50%, we added back. So Closing stock for the year ended 31st March 2024 are 55,000. Now let's this is the calculation you can go through. Now let's calculate gross profit. Total minus remaining balance of debit side. Total of credit side minus total of debit side. Then we will get then here let's calculate gross profit. 78,750 is the gross profit and 3,15,000 is the sales. So gross profit divided by sales into 100 is 25%. Here is the calculation you can go through. Now opening balance. Opening balance is equals to closing balance of the last year. So 55,000. But here they have clearly mentioned that on May uh, what is the abnormal good? Which is what is the abnormal good? Total abnormal good 6,000. How do you get to know? 50% of which originally cost 6,000 had been written off, which means its total value is 6,000. In valuing this stock on 31st March 2024 due to obsolescence, 50% of the stock which originally cost 6,000 had been written off. Then this 6,000 is the total value of abnormal good. Good. So the same is taken here. Then normal good is equals to total closing stock minus abnormal stock, which is equals to normal stock. Then purchases for the till the date of fire is 1,45,000. Purchases is equals to 1 lakh 1,45,000. Sales is equals to 1,84,050. Now here do we have any abnormal sales? Look at here. In May 2024, 3/4 of this stock had been sold at 90% of original cost. Here 6,000 is the abnormal good into 3/4 is 4,500, which is sold for 4,050. 4,050. Then 450 is incurred loss by selling 3/4 of the abnormal good. Then remaining is 1/4 is valued. Remaining is 1/4 into 6,000 is the abnormal good is equals to 1,500 worth of goods are still in stock, closing stock. So which is valued at 90%. Then 1,550 is the abnormal good in the stock, but 10% is loss. So total loss is equals to total abnormal loss is equals to 450 plus 100 is equals to 600. Now gross profit. Gross profit is equals to 1,000, 1 lakh, 1 lakh, 1 lakh 80,000, 1 lakh 80,000 into 1 lakh 80,000 here 1 lakh 80,000 1 lakh 80,000 into what's the gross profit percentage? 25%. Then we calculated closing stock on the date of fire. How do you arrive at this problem? This is equal. is equals to total debit because this is the debit balance is higher. So total debit minus remaining credit balance is equals to closing stock on the date of fire, which is balance amount. Now let's calculate amount of actual loss. Actual loss. Stock on the date of fire. Stock on the date of fire is equals to stock on the date of fire is equals to 60,350 60,350 minus salvage. Sorry, 60,350 salvage is equals to salvage is how much? 7,200 stock to the value of rupees 7,200 was salvaged. Salvage amount is 7,200. Fire extinguishing expenses. There is no such information available. Let's consider zero. Let's assume there is no such expenses is equals to stock on the date of fire minus salvage plus, if any, gross the fire extinguishing expenses, which is 53,150. Here, next, before calculating amount of claim, we have to know what is the policy amount, what is the worth of insurance purchased. There is no such information regarding policy amount, insurance policy. So, assuming it is fully insured, then amount of claim is equals to actual loss. Thank you.